Fixed mortgage rates have been dropping, and right now the best 3-year fixed rates we're seeing are close to 5.78%. On the other hand, variable rates are sitting at 6.5% these days, and it hasn't moved much because it does follow Bank of Canada's rate decisions. So this actually makes fixed mortgage rates look visibly cheaper compared to variable rates these days. But wait, 9 out of 10 mortgage lifeguards are saying go with variable these days. So which one should you actually go with? If you're new here, I'm Samantha Chan from Elevate Realty, and we're all about helping you make smarter real estate decisions in Toronto. Don't forget to hit that like button and subscribe to our channel if you enjoy our content. In this video, I'm going to break down whether fixed or variable is the better choice for you. Let's dive in. Here at Elevate, we're not economists, and so we are going to defer forecasts to the big banks to get a better sense of where interest rates might be going. And these days, we are seeing more clues now that the 2025 forecasts are slowly coming out. So based on these forecasts, let's say we get a 3-year mortgage at the start of 2024. Right now, fixed rates are 70 basis points cheaper, and let's assume that it stays that way at the start of 2024. We'll also try to go more conservative and assume that the higher variable rate at the beginning of the year will stick around for the entire year. So for the first year in 2024, fixed rates will be cheaper. And then as we move to 2025, we'll keep going conservative and use the highest forecasted rate from the big banks. So right now, BMO does suggest that variable rates will be around 50 basis points lower than they are now. And if that happens, fixed rates end up being 20 basis points cheaper for 2025. Now let's fast forward to 2026 and variable rates might drop by another 125 basis points. If that happens, variable rates will end up being the winning choice in the last year, and it's going to be a much bigger difference of 105 basis points. So, using our pretty conservative stance, we still see variable rates being the cheaper option over the next 3 years. But if you do decide to choose variable, make sure you understand your risks. As you probably know by now, variable rates can be very risky. Now, by going with a variable mortgage, you are sacrificing the predictability of a market-proof fixed rate mortgage that gives you more stability. You've probably heard the saying, high risk, high reward, and this is what a variable rate mortgage typically gives you. Another downside is that since variable rates are higher at the start, it does mean that you will qualify for a smaller mortgage. Right now, at 70 basis points, it's actually not a substantial difference, but if this does increase in the future, it could potentially mean more of a difference. Now, going variable isn't always bad in terms of risk, and sometimes it could actually work out for the right mortgage holder. For example, investors that take on big projects typically have to fork out renovation costs up front with cash, and then later on, they would refinance the property to cash it all out after the project is done. And if you do this, then going variable might end up being the better option if fixed rates fall in the future, because the penalty for breaking a fixed rate mortgage might be pretty hefty if that happens. The other benefit is that opting for a variable mortgage right now can actually give you more flexibility. So basically, if you think your personal circumstances might change a lot over the next 3 years, or if you have a strong viewpoint that fixed rates might come down more in the future, going variable right now might actually be the right choice for you. Either way, looking at these bank interest rate forecasts, there's definitely more buy signals going off today compared to the past year and a half. Just take a look at the semi at Queen and Dufferin that our sales team just secured for a client. Because of our slower times, this house ended up sitting on the market for a month and a half at $1.149 million. We projected that we might get it for $1.1 million, and once we split this house into 3 units, we can get $7,500 a month in rents. And using interest rates at 6.5%, this already gives great positive cash flow at $800 a month. Now, our market is very buyer friendly these days, and a lot of times we end up being able to bargain down even more, and that's precisely what happened here. Our sales team ended up locking this home up for $1.05 million, so the returns look even better at this price. And then if we adjust this for the new lower fixed rate of 5.78%, you can potentially get even higher cash flows on day one at over $1,400 a month. The reality is there's always going to be more uncertainties that pop up. Recession talk, unemployment fears, and even news about people moving out of Canada. But here's the thing. Our slow housing supply growth and our high immigration goals are real, and that's going to keep prices and rents strong. Plus, if we look at the basic idea, when interest rates drop, home prices rise, this will also help reduce the risk of investing in Toronto real estate today. If you want to learn more about investing in real estate in Toronto, just reach out to us. We're not your typical real estate sales brokerage. Instead, we focus on using data and numbers to help me make smarter real estate decisions in Toronto. This means looking for houses to invest in with positive cash flow, carefully managing risks, and maximizing your returns, all while guiding you through the renovation process if you need it. So when you want to discuss your private real estate situation with us, just head over to this link here to set up a time to chat. Don't forget to like and subscribe and share this video if you know anyone that might benefit from it. There's also more real estate and investing content for you to check out on our website or on social media. Thanks so much for watching, and I'll see you in the next video. Bye.